I do think they are, and I think that investors have a tendency to overreact to earnings. Not just me, there's a literature on this. They think that the rapid earnings growth that we've seen in recent years is justifies more than, well, approximately 1-to-1 increase in stock prices. But historically, it doesn't.
When you say a 1-to-1 increase in stock prices, what exactly do you mean? A 1% increase in earnings? I mean, how does that work?
Yeah, so from the bottom in the first quarter of 2009 until present, the stock market has, well, the corporate earnings, S&P earnings, reported earnings per share have gone up 3.8-fold, while the from March of 2009 to the present, the stock market, using monthly data, has gone up 3.2-fold. So it looks justified, right? Stock prices have gone up less than earnings. But you have to remember that earnings are volatile and that they shouldn't go one for one. And that mistakes like that have driven stock market errors in history.
Is it not right, though, to just look at stock prices and stock valuations? I mean, we're also in a market where bond yields, even at 3.11%, I mean, they're still very historically low, effectively. So people are holding on to bonds. I mean, doesn't that show you that perhaps there is some skepticism in the market, even if you don't think that it exists in the stock market?
Right. Yeah, the interest rates are a factor that helps explain the stock market. For example, the market was very low in 1982, and interest rates were double-digit. There is an overreaction, I think, actually, to interest rates. The problem is that interest rates are likely to go up, at least at the short end, with the Fed plans, and so that doesn't bode particularly well for the market either.
So you seem to be saying, if I'm hearing you right, Robert, that investors should watch earnings and their volatility, and earnings have been doing pretty well. What could change that and cause those earnings to decline, or the stock market is really a discounting mechanism for earnings, could cause those discounters to say, oh, a decline in earnings is coming? Is it a recession? Is it trade? Is it a slip up on the geopolitical stage? What could do it?
Well, a lot of things could do it. By the way, I've been advocating using the CAPE ratio, cyclically adjusted price earnings ratio, which just uses a 10-year average earnings rather than trailing 12-month earnings. And that's at a high level now, and the U.S. is the most expensive country in the world. So, yeah, people believe in these earnings growth. They think that maybe it's the Trump revolution. But actually, it's been going on long before, the growth has been going on long before Trump. A narrative, yeah, I think market is driven by narratives. And right now, it is kind of a Trump narrative that's supporting our faith in these earnings numbers. Even though, you know, historically, strong earnings growth has generally been reversed before too long.